Renault, the French-listed car company, has a new CEO and recently announced that it's going to restructure, cut costs and focus on small cars. Mr. Senard, the chairman, sounded very positive, and he went on to say that he saw the Renault alliance going on to be one of the most powerful combination of companies in the world. We think this is delusional. We see a board stuffed with vested interests that approves accounts that are totally misleading and sail remarkably close to being outright fraud. Unfortunately for shareholders, the group is audited by Ernst & Young, the rather sleazy accounting group behind so many of the recent auditing scandals. It seems to us that the company is being run for the benefit of its various vested interests, rather than for the minorities who are seeing their wealth destroyed. The latest accounts confirm that Renault is still using offshore and off-balance sheet vehicles or slush funds that concealed their financial arrangements in the past and enabled the directors to duck their fiduciary responsibilities. Ghosn may have been greedy, but based on the accounts, the Renault board and senior Nissan directors either knew what was happening and have attempted to cover it up, or they were incompetent. Either way, minorities should be calling for all of those directors should be fired. Instead, most are still in place, executive pay and board compensation continues to rise, and the vested interests remain entrenched. We think the long-term future for Renault's equity holders looks remarkably grim. But before we go on, I must remind you that under Hong Kong SFC regulations, we can't make stock recommendations to the public, and none of what follows should be taken as investment advice. Renault's glory days are long gone. Over the past 17 years, its growth's been modest, slower than both the market and their German and Japanese peers. However, the real problem is that although Renault reports accounting profits, in reality it's lost money. It's no wonder that despite some rather exuberant share price rallies, the stock is back where it started. Part of the reason for this is that Renault seems to be run by the directors for the benefit of their patrons and not for shareholders. We find it incredibly disappointing that its large institutional shareholders, many of whom tout their ESG investing credentials, are prepared to back such poor governance accounting practices, as well as approving such dodgy accounts. I will use our standard governance, accounting and peer performance approach to illustrate the issues. Governance. Renault has 16 directors, many of whom have an affiliation with a vested interest. There are representatives for the French state, for the employees, for Nissan, Daimler and past management, but it's remarkably hard to spot anyone who's aligned with and obviously fighting for the minorities. A good illustration of this is that none of the directors appear to have bought a material quantity of shares, so while they collected their ever-rising fees and management their bonuses, they've all been largely immune to the pain suffered by the minorities. Ironically, the largest shareholder on the board was a Nissan appointee, Mr. Yamauchi, who recently resigned. Perhaps it was costing him too much money to stay on the board. The board also seems to have very little auto or manufacturing experience. The recent appointment of Miss Winkler is an improvement, but even she has a vested interest because there's supposed to be a working relationship between Renault and Daimler. However, the board keeps busy and has meetings that tick all sorts of supposed ESG boxes. For example, they evaluate themselves based on their attendance, their diligence and efficiency, as well as the quality of their informal lunches. Sadly for minorities, there's no mention of shareholder returns or financial targets. They do say, however, that they're supposed to review the company's strategy and budget, but based on some of the recent directors' comments, it's clear that there's some discontent over what actually happens. We suspect that someone has finally realised that there's been some divergence between what is said to happen and what actually happens. The compensation policy has a similar tick the box but ignore the reality approach. There are lots of worthy sounding statements, but a close look reveals that the actual targets are somewhat naive. Shareholder returns appear to have been added as an afterthought and certainly well behind political and social concerns. Despite highlighting their ESG approach, the board has been happy to go along with the use of off-balance sheet and possibly tax evading slush funds. This is something of a surprise when you consider this was presumably approved by Mr. Macron, the French president, the French government, the car workers' unions, and Mrs. Blair, the wife of a UK Labour Prime Minister. It was by using one of these slush funds that Mr. Ghosn was able to extract so much money. The problem for Nissan and Renault is that they both had executives on the board of the slush fund, and payments would have had to have been approved. Ultimately, it looks as if Mr. Ghosn was greedy, but not necessarily fraudulent, whereas the Lisco directors clearly failed failed in their duty to monitor what was going on. We think these off-balance sheet companies are one of the keys to Renault's governance problems. Reading the alliance agreements underpinning the establishment of these companies, they appear to allow the executive directors to overrule the Renault's board. We think it's shocking that the board effectively absolved itself of its fiduciary duty to shareholders, ignored the value destruction at Nissan, but is yet to suffer any consequence. Mr. Senard says that the alliance government's practices have changed, but unless the rules have been rewritten, of which there is no evidence, we remain sceptical. Even if you believe that things have changed, it seems that the directors have now effectively given up trying to control Nissan and are leaving the company to run itself. This is despite the fact that the stake remains a material proportion of shareholders' funds. Accounting. Renault's balance sheet is a nonsense. The Nissan stake is included at a valuation that had no bearing in reality, and that was pre-COVID. The valuation was justified using a perpetuity growth rate that far exceeds Nissan's growth over either its recent or medium-term history. The assumption looks even more stupid post-COVID and the announcement of production cuts. The problem we have is that this was not only approved by the board, but also by Ernst & Young, their auditor of 40 years. But I suppose if phoning the bank to check Wirecard's cash balance is too hard for E&Y, comparing the assumptions used in a DCF to reality is probably far too much to ask. Mark the stake to market and 40% of Renault's equity would be wiped out. The P&L also looks somewhat suspect, and we think profits have been inflated by under-depreciation, because in a mature, largely ex-growth business, CapEx should broadly match depreciation. However, since FY 2014, depreciation has fallen as a percentage of long-term assets and has been significantly below CapEx. If the two had matched, most of the core operated profit would have been wiped out. Renault does acknowledge that depreciation will rise, however they suggest that CapEx and R&D will fall. This looks somewhat unrealistic to us given that the industry is going through a major technological shift and Renault is already struggling to keep up. The next opportunity for creative accounting comes from their in-house bank. In FY 2019, reported sales financing margins were close to 50% and the profits were nearly 1.5 times those of manufacturing. This looks great, except for the fact that these numbers are accounting fiction. In reality, the manufacturing arm subsidises the bank and provides nearly half of its profit. This sleight of hand nets out on consolidation, but the key point is that it flatters the bank's credit metrics. Improving the bank's metrics matter because the bank can lever up at 10 times, far better than the 3 to 4 times leverage given to an industrial company. They obscure the extra leverage by classifying all of the bank's financial assets and liabilities as being current, even though they're not. A casual observer might look at the balance sheet, take both items as working capital, and net them off without thinking about the long-term impact of the extra leverage. There is another problem. The bank's subsidy incentivizes the bank to grow assets. This could mean that the bank will prioritize growth while sacrificing quality and margin. Good for the bank, but potentially hurting returns for the consolidated group. In another interesting twist, Renault doesn't book all of its car financing transactions through the bank. Most of the residual value or guaranteed buyback deals actually go through the manufacturing arm. This seems a little odd until you realise that these deals include a depreciation charge. As such, including them in the manufacturing arm has a disproportionately positive impact on EBITDA, which is very handy if you can persuade investors to look at EBITDA-based valuations. Despite these issues, the auditors say the presentation of the accounts is fair. They go on to say that they've just done what the law requires and all responsibility rests with the directors. The auditor is then further protected from any blame because there are two. Presumably in the event of a complaint, it will be impossible to find anyone who actually takes responsibility. Performance. Renault's share price is not depressed. It simply reflects the rather grim business reality. Because over the long term, Renault has lost money producing and selling cars and destroyed its shareholders' wealth. Part of the reason for this poor performance is that, unlike nearly every other car company, employee productivity has steadily got worse. And by 2019, Renault had the lowest employee productivity amongst the major producers. It's more difficult to compare asset productivity across the industry due to accounting differences, but it is quite clear that when you look at Renault's history, their productivity continues to drop. Recently, reported margins have been improving, but as we noted earlier, most of this improvement has come from falling depreciation rates. Adjust operating margins for CapEx instead of depreciation and strip out the share of Nissan's earnings, and Renault barely breaks even. The next problem is that Renault has been paying cash dividends out of its accounting profits, when in reality reality, cash profits were close to zero. They effectively funded this by squeezing their suppliers. This can work for a while, but it's obviously not a sustainable source of capital. They compounded the need for capital by expanding their financing operation. This props up demand and increases the profit achieved per vehicle, but it increases leverage and exposes Renault to credit, interest and residual value risk, the full cost of which usually comes later. The extra profit did lift their operating return on producing assets, but it still remains so far below Renault's peers. Theoretically, this means there's plenty of room for improvement, but we think they will struggle to turn things around while the board continues to pander to the vested interests. To us, Renault has two choices: increase revenue by lifting prices and/or volumes, or cut variable and fixed costs. The recent restructuring plan looks to be far too modest, and more importantly, it fails to address the productivity problem. Refocusing on small cars and cutting production will presumably mean that overall revenue will drop. They are looking to cut fixed costs, but by less than they're reducing volumes, so unless they can substantially increase operating margins, overall margins will get worse. They mention personnel changes, but it's not clear how much of these will translate into job cuts, and again, the numbers look to be less than the production cuts. We don't see how margins can possibly improve. We suspect that part of the problem is that the French government is busy fighting against factory closures and employment optimization in France. This may suit the government, and given their influence, they could insist that Renault stays in production to maintain employment, even if Renault loses money. This seems most likely in 2020, when we expect their core operations to lose at least 1.2 billion due to the COVID slump, and they've already announced another 1.2 billion of cash costs due to the restructuring. Shareholders would be wise to note there is no limit to the amount of money Renault can borrow, and the government seems willing to support the board borrowing as much as it wants, even if, or perhaps especially if, this allows management to duck the tough decisions. We can't talk about valuation apart from in the most general terms to avoid breaking SFC rules, but we think we're safe in saying that while Renault and Nissan look cheap on historic numbers, you need to adjust these for this year's losses, write down the Nissan stake, and even then we don't think the reported numbers represent the full story. We can only advise investors to be careful. If you want to dig a little deeper, visit the Renault page on bucef.com using the link below. There you can see the questions we think investors should ask and download some of the recent filings where we've highlighted the key points. To keep up with our reviews, subscribe to our channel or send us an email, but before you go, please remember none of this should be taken as investment advice. We've sourced the facts from the company documents, but the interpretation and conclusions are just our opinion. We provide these videos for education purposes to expose what we perceive to be creative accounting. Thank you very much for your time.